Hello all, hope you are doing good. Am I audible? Please raise your hands if you can hear me. Okay, I can see people raising hands, so chalo. So how to find good investment ideas? So that is what we are going to cover in this particular session. So far we have covered balance sheet, income statement, cash flow statement, profitability, growth analysis, and how to find the financial fakery. So pretty much we are done with the financial statement analysis. Now let's apply that whatever we have covered so far in this particular session. So that is how to find the good investment idea. So we are going to use the financial statement analysis to find great investment ideas. So around in 1993, so Adam Smith interviewed Warren Buffett. So and this is what he asked, like how small investors can find good investment ideas. So that is what Buffett was asked. So Buffett replied, I would tell him to do exactly what I did 40 years back, which is to learn about every company in the United States that has publicly traded securities. That is every stock in United States, and that bank of knowledge will do him or her terrific good over time. So this is what he said. Adam Smith got confused and he said like there are 27,000 stocks out there. Buffett replied, well, start with the A's, A, B, C, D. So he said, go with the alphabetical order and learn about all the stocks in United States. But you don't need to do that, in fact, because the biggest advantage to our generation is technology, which even Buffett, didn't have when he started, making his investments. But if at all you want to apply the same process, I wouldn't recommend you to go through like entire like 5,000, 6,000 stocks, but you can start it simple. For example, take an index like Nifty 200. Now there you can basically list out, you can take that 200 companies list and you can discard every company that doesn't fit your criteria. And you can keep the companies which are high quality, trading at favorable prices, high growth company. So you can keep those companies and you can add them into your portfolio. So if not all 5,000 companies, you can start with something like Nifty 200 or BSE 500, some list. You can apply that process here. But what we generally do is in our process, we use stock screeners. Of course, there are many screeners, but you already know we use screener.in. But there are so many alternatives as well. But I think for Indian stocks, screener.in is the best, where simply we kind of input all the criterias, whatever we want. It can be debt to equity ratio, it can be price to earnings ratio, market cap. You can keep whatever criteria you want into that query box and run the query. So based on your query, so as you can see, these are some examples, queries that I have mentioned here. So once you input all those queries and run the query, so all the stocks in India that fits that particular criteria will show up on the screen. So from that list, you can discard the ones that you don't like and you can dig deeper on the stocks that you feel are worth it. And based on again growth, quality and price, you can go ahead and invest in those stocks. So that is one way to do it. The second is 52-week low, that is disgrace stocks. So once in a while, I stopped using this because now I am completely using screener.in, but I just want to mention it. So 52-week low list also you can use if you want to. But you have to be little cautious while using this 52-week low because most of the stocks you find here deserve to stay there. For example, this 8K Mile Software Solutions, I have just covered about this stock last week only. So one of the stocks where we were looking at this stock last week and we found so many red flags, right? So that company deserves to be in this particular list. So just because the stock is trading at 52-week low doesn't mean it's a great investment. So 8K miles or whatever, all the stocks that you see here, you have to dig deeper. And if you like, after digging deeper and you like it, you can invest, or else you have to discard. The third way to look at the ideas is basically through general observations. You might be using a product or a service and you like it, and you think there is a lot of room for growth, and demand is picking up. If you can see that, and if it's a listed company, of course we use many products and services, but not every product is a listed company. So if it happens to be a listed company, so you are using the product, you understood the demand for that product, and you realized it's a publicly listed company, which is it's a stock, then you can dig deeper, then you can invest. So it's a way of how to find the ideas. So through observations also you can find ideas. For example, you might be buying groceries at DMart. You may not know DMart is a listed company initially, but after looking at the demand for that business, maybe you kind of searched it online and you realize it's a listed company. Then you kind of analyze the company, you liked it, you invested. So that can also happen with any product or service out there. Next is business media. Of course, I don't regularly watch news channels, or I don't even read newspapers that regularly. But you can find ideas from the business media. But for example, you can see they have mentioned a stock here. So hot stocks, and they mentioned a stock. Most of these might be overvalued stocks or momentum. Sometimes it is pump and dump also. So I don't mean to say that just watch news channels and invest in whatever stocks they mention. No, that is not the thing. We have our own process, how to identify a stock, how to analyze it, how to value it, and eventually how a particular stock ends up in our portfolio. There is a rigorous process that goes through. What we are covering here is best basically to find an idea. So you might have seen this particular stock here from some news channel or from newspaper. It's just an idea. Now you dig deeper, you do your homework, you analyze it, and then you invest in it if you like it. So just because you find it in a news channel doesn't mean it's a great idea, doesn't mean it's a great investment. It is just an idea. You have to do the hard work. Now whatever we have covered here, you want to, you can use all those things, but generally what I use is screener. Like 99.99% of the ideas or the investments that we make happens through screener. So let me show you how screener works. So as the name suggests, screener.in, as the name suggests, you can basically screen the stocks here. So if you click on screens and if you click on create new screen, so create a search query. So this query box will show up. You can input whatever, a criteria you want. For example, I want sales growth. Let's say sales growth for the last 3 years should be greater than, let's say, 30%. If I run the query, as you can see, there are 1012 companies, more than 1000 companies in the last 3 years generated more than 30% growth. CAGR, that is CAGR, more than 30% CAGR growth in sales. Of course, apart from sales growth, we also look at the net profit growth also. So I want to add the net profit growth, or just profit growth, I would say. So let me add the profit growth last 3 year should be greater than, again, 30%. If I run the query, as you can see, from 1000 the number dropped. We can add as many queries as we want. For example, I want the debt to equity ratio less than 1. So as you keep on adding more queries, the number of stocks will kind of reduce. So that is how screener works. And how I used to use screener is maybe somewhere around before COVID. So I have my own criteria, some 18, 19, I guess, some 19 different criterias that I have used previously. So first is the debt to equity ratio should be less than 1. So if you want, I can, I mean, anyway, you will be getting this video, right? So you can check it from the video itself. So first is the debt to equity ratio. So debt to equity ratio should be less than 1. So what I want to capture here with that particular criteria is financial health should be strong. The company should be able to meet its long-term obligations. So that is the first criteria. Next is profit growth for 5 years and profit growth for 10 years. Why I want long term growth? See, high growth in last 1 2 years is not what I am looking for. Generally, I am looking for a long term growth, sustainable long term growth. So historically, I want to look at a minimum of 5 to 10 years of data. And in both instances, I want the growth should be more than 15% compounded growth. And here, 5 year and 10 year, more than 15% is what I have mentioned. And operating cash flows. So here you can see operating cash flows. All these are cash flow related, criterias. So cash flow from operations 3 years, 5 years, 10 years, last year, preceding year, free cash flow for 5 years, free cash flow for 10 years. For every query I have mentioned, it should be greater than zero. Now, what I'm trying to capture here is basically I want the cash to come into the business, not go out of the business. I haven't mentioned a number like cash flow more than 20 crores or 50 crores or 10,000 crores. Why? Because each company size is different. So, as long as the number is positive, I'm happy. So, the cash should come in, it shouldn't go out. So, again, same applies for cash flow from operations and for free cash flow as well. So we call it as quality of earnings, right? So I want the high growth in profits, which means the income statement is saying that it's a profitable company and growing at a high speed. I want the cash flow statement to narrate the same story. If cash flows are negative and the company is, reporting great profit growth, most of that profit might be paper profit. I want real profit, so that is what I want to. I'm trying to understand using these criterias. Next is return on assets for 3 years and for 5 years should be greater than 8%. If you can remember in the profitability analysis, I've already covered this. So basically, we look at return on equity. Should be more than 15%, but return on equity can be boosted using leverage. So return on assets, if it is 8%, then uh, basically it captures the quality of profitability. So along with high profitability, I want high quality profitability as well. So that is the reason I am using return on assets for 3 years and 5 years more than 8%. Now I am looking at the actual profitability as well. So anyway, since return on assets more than 8% is anyway a proxy for, it is anyway a proxy for return on equity. So that is the reason now I am using return on capital employed. So here you can see average return on capital employed for 3 years, 5 years and 10 years. Again, I want consistent long-term data. I have mentioned it as 20%, but 15% is what we generally are okay with. But chalo, I want to be a little conservative. I have inputted 20% here. So since I am using 20%, I've ended up with 68 stocks in the list. But chalo, 15% is also fine. So if I change it to 15%, I think most probably the number of stocks in the list will go up. So as you can see, it became 111. So it's okay. Like 15% is also fine, 20% is also fine. So I'll go with, let's say, 15%. So again, I'm trying to understand the quality as well as quantity of the profitability. Next is pledge percentage should be less than 10%. So here, if the promoters of the company are very confident, then they should be holding, maximum stake, possible stake. Pledging is not selling, but it's an indirect way of selling the stock. If the promoters are selling stock, the market will notice, and their selling in huge quantities might affect the share price. But what if they go to a lender, a financial institution, and they say like, you keep this, shares as mortgage and give me money. So it's an indirect way of, transferring the shares. And eventually, if the promoter doesn't pay, then that lender will start selling those shares in huge quantities in the market, which will eventually make the stock to crash. So here the promoter is not selling directly, but it's an indirect way of selling. Up to 10% is fine. if he is pledging the shares and using that money for some personal reasons, which is okay, but up to 10% is fine. If it is more than 10%, then I think it's a red flag for me. Next is change in promoter holding for the last 3 years shouldn't be more than 15%. Generally, if I am buying a stock, I want the owner to stay intact with the business. I don't want the owner to sell the business. Then there is no point for me to buy the stock. If I am buying and the owner is exiting, then why should I buy it? So generally, I don't like owner exiting the stock. But here, once in a while, for various reasons, some promoters may sell some stake for personal use, which is okay. But huge quantities is my issue. So in any given 3 years, last 3 years, if that selling is more than 15%, I don't want that company to show up in the list in the first place. So that is what I have mentioned here. And current assets should be bigger than the contingent liabilities. Now, with this, what I want to protect my capital is through saving myself from bankruptcies or defaults. What exactly is this contingent liability? It's a liability, but it is not a guaranteed liability. Like we can call it as a provisional liability. So, for example, there is a case, pending case on the company. If the company wins the case, the company doesn't have to pay anything. But what if the company lose that particular litigation? In that case, the company might have to pay, let's say, 100 crores. Now, 100 crores is the litigation amount, which may or may not be paid by the company based on the court order. So, based on the verdict, whether the company has to pay or not will be decided. But up until that point, it will be a contingent liability. So, it can be a tax liability, it can be a court case, it can be anything for that matter. What I want is survival. Now, as long as the current assets, what is current asset? Any asset that can be liquidated within 1 year. So here, all these are current assets. They can be liquidated immediately, right? So if there is a contingent liability of, let's say, 100 crores, but the current assets of the company is, let's say, 500 crores. So with or without that litigation, the company can survive. So I am looking at the survival of the company here. So the current asset should be bigger than the contingent liabilities. So that is what I have mentioned here. Last is market cap. I am kind of agnostic to market cap, but what I generally believe is sometimes I go up to 300 crores also. So here I have mentioned it as 500, but sometimes once in a while I may go up to 300. But even if I, you know, reduced it to 300 crores, I don't think the number has changed. I mean, 119 with 300 with 500 also, it's only 8 companies increase. So the difference isn't that much. So I'm going with the 500 itself. So as you can see, after inputting all these criterias, how many companies showed up in the list? 111 companies showed up in the list. Now, less than 20 PE is what we generally use for discarding the stocks. So, how many companies? Okay, 29 companies, as you can see here. So, the first 29 companies are trading below 20 PE. Remaining 80, some 80 plus companies are trading above 20 PE, so they don't deserve to be in our investment portfolio. So our focus is only on the first 29 stocks. So I may go through all these 29 stocks one by one, and again I might have to discard some companies here also. I mean, there might be some cyclical companies, they might have shown up because I've taken 3 year, 5 year, 10 year average. So in that 10 year, if there is a one big period, some one time big gain, that company, because of the average, that company might also end up in the list. So I am not going to blindly invest. This is just a way to find ideas. So I am going to dig deeper with each and every stock that I find here. So eventually, if I like something, maybe I'll invest. So that's of I mean, the process is pretty rigorous after this. So what I'm covering here is basically how I generate an idea. Once I generate the idea, I go through balance sheet, income statement, cash flow statement, profitability, I go through industry analysis, management analysis, then comes the valuation. After all this exercise, if the stock is trading at a favorable valuation, then we might invest. So the analysis starts here. It doesn't end here. You need to understand that. But of course, I have used this up until COVID. But after COVID, I stopped using this process because of COVID, that one bad year, because of lockdown or many other reasons, some good companies stopped showing up in this list. And there is a reason for that. As you can see, there are 3-year, 5-year, 10-year averages we are using for most of the queries. So because of that 3-year, 5-year, and 10-year, some good companies stopped showing up here. But they are investable companies. Just because the average is skewed, they are not showing up. So how to find them? So now I am using little, I stopped using the shortcut and I am using this process now. So now, for example, I am going to start VD 3.0 or whatever the monthly, stocks that I have recommended so far. Everything that I have recommended so far is basically through this. So I use only two criteria now. One is market cap, more than 300. Like I already mentioned, I sometimes use 500, sometimes use 300. So here what I am using now is 300. So market cap 300, that is my first criteria. Next criteria is directly pricing related. Price to earnings less than 20. So instead of using 18 or 19, now I am using only two criteria. But when I run this query, 525 stocks will show up in the list. Now I go through each and every stock. Basically, it's an exercise. Now I am going to take this exercise even rigorously because I have to find one idea every month. Of course, I might have received many questions over the week, like over the past few weeks, saying like, Vishnu, how you are going to find that one new idea every month? So like I already said, I am going to reduce some stocks from my already tracking list. So that gives me a little space for research. On the top of that, finding one idea from 525 stocks is not impossible. I would say it might take some hard work, but not impossible. I might find one good idea out of 500 stocks. So one good idea out of 100 is also possible, but some good ideas are not showing up. So that is the reason I'm using this. And it is up to you. What you want to use going forward, it's up to you. If you want to use this criteria and you are okay with the lower number, and if you want to reduce the number, like if you feel like I can't analyze 100 stocks, then you can basically, instead of 15, you can input it as 20. You can change it because 20 is also fine. Then you can reduce the number to 68. Then if you look at the PE ratios, only first 14, I guess. Yeah, only first 14 companies uh, are below 20p. Remaining companies are above 20p. But again, like I said, please don't blindly invest. For example, there is control print here. So you open control print and you kind of go through the ideas. I mean, you go through the financial statements. For example, if you look at control print, sales growth is good. As you can see, 200, 250, 300, 400. So sales growth is good. And profit growth is also good, 40, 50, 100. So profit growth is also good, but what you can see clearly is there is a negative 15% tax. Is there any tax benefit they have got? We have to dig deeper for that. But first red flag for me is like they are consistently showing sales and profit growth, but profit growth is not the actual profit because there is some tax benefit happened here. That is one. uh, to check my thesis, I have to check the operating margins here. So operating margins also dropped from kind of 24% to 19%. Operating profit also dropped, the actual profit 86 to 80. So sales growth is good, but operating profit dropped for various reasons, maybe raw material cost or whatever it is. But it is kind of adjusted. Or did they smoothen it to kind of show that high growth? Maybe they might have some tax benefits or deferred taxes. They might have used it here. Exactly, I don't know, but I don't want to spend that much of time. I just want to show it as an example. But something is off. So I have to dig deeper because on this. So margins dropped, operating profit dropped, sales growth is there, net profit growth they have shown reported profit, but tax rate is unusual. What exactly reason I have to check? Only then, maybe after doing all that analysis, if I like it, I may invest. If I don't like it, I may discard. So same applies here also. The same process applies. 525 stocks. I go through all the stocks. I will go individually through each and every stock, but I am not going to spend 1 day or 1 hour or even 1 week on a stock. Maximum I'll spend, let's say, 1 2 minutes on a stock. For example, there is Reliance Infra trading at 1 PE. So 1 PE sounds lucrative, right? Price to earnings ratio of 1 definitely sounds lucrating, but just because it is trading at 1 PE, we don't invest, right? For example, you can, okay, just at a glance, you can see that it's a loss making company. So all the loss making years. And one more thing you need to understand is sales growth is pretty muted. Current sales growth, sales is 21,000 crores in 2016, 26,000, 19, 25. So from the peak of 2016, if you consider the sales growth is lower. So it is negative sales growth from the peak. But if you take the entire 10-year period, it is almost muted. And absolutely erratic growth rate. All the loss making years, we generally don't invest in loss making companies. But you can say like the current year's net profit. I hope you can see the screen. One second, let me check. Okay. So as you can see here, the current net profits is fantastic. Like 9,000 crores, 8,000 crores. But this is what I say, you have to dig deeper. There is 8,000 crores of other income, 9,000 crores of other income. So out of this 7,000, 8,000 crores of profit, the other income is actually bigger. And they are not even paying taxes also here. Taxes is 0, -6. Of course, they have made some losses. So they are basically carrying it forward into these years, which is fine. But very erratic. Why do you want to invest in such erratic growth companies, completely dependent on other income? Of course, how they are generating that other income, there might be some exceptional items. Okay, somewhere around 1,000 crores is exceptional, but remaining 7,000 crores, they have mentioned it as other income normal. Let me check the balance sheet. So investments, okay, 10,000 crores of investment. There might be some cash also. Okay, some 3,000 crores of cash. So overall 13,000, close to 13,000 crores of 13,500 crores of investments and cash that they have. On 13,000 crores, it's crazy that they are generating like 7,000. That is 50% return. They invested 13,000, got 7,000 as return in this year, so they got 50% profits. Where FDs doesn't provide 50%. Even mutual funds and stock market, I mean, I'm invested, so I know how much returns the market has generated. So stock market didn't generate 50%, FD, liquid funds, nothing. Where did they generate? So I have so many doubts after going through all these things. Okay, what about the interest? What about the debt that they have? Okay, debt reduced. You can see here the debt. Chalo, what we'll do is, okay, we'll export this file and we'll see like what's happening. So as you can see, I don't do all these things, but I'm just showing you so that you know like what to look for. So 2 minute test is more than enough. Like you can see all the red flags. But what I have doubt is with, okay, let me check the balance sheet first. So balance sheet, okay, borrowings reduced from from almost 17,000 to 6,000. So balance sheet is getting stronger. Am I right? Balance sheet is getting stronger. And financial health, okay. Debt to equity ratio is 0.44, which is less than 1. But financial leverage, okay, they have covered the debt to equity part, but they missed the financial leverage part. So this is why people ask me, like, when debt to equity ratio and financial leverage is basically helping us in knowing whether the company can meet its long-term obligation or not, then why we are using both the parameters? We would have used, let's say, just debt to equity, ignore financial leverage. This is the reason. Sometimes companies can fool us with debt to equity, but financial leverage will help us at that point. So here debt to equity ratio is good. But what's happening here? Okay. Borrowings reduced from, let's say, 22%, 20% of total assets to 10%. Borrowings reduced. But other liabilities from 60% increased to 68%. So close to whatever they have reduced here, almost close to that is increasing in the other liabilities. So did they really paid their debt, or did they just move it to other liabilities line item? It is just the payment of debt, or is it transfer of debt? Okay, let me check the interest expense. How much interest expense they are paying? So interest income, okay, 7,900, close to 8,000 crores is the, no, sorry, that is other income, right? So let me check their interest. So 1,800 crores. Yeah, 1,800 crores is their interest expense. What is their debt on the balance sheet? 6,000 crores. They are paying almost 2,000 crores. 28% they are paying on interest. 28% interest. So they have capitalized some of the debt and they are showing it on the other liabilities. This other liabilities, they might have capitalized the debt and they are showing it here. But the interest expense helped us in understanding that, and the financial leverage also kind of helped us. So please be careful. I have no interest in Reliance Infra or whatever they do. I mean, they can do whatever they want. Uh, I have nothing personal. But the only issue here is whenever you are going through the list, just because the stock showed up in the list doesn't mean you directly go and invest. You will find many companies which doesn't deserve our investment, and it is your job basically to identify it and discard it. So I might spend 1 minute, or most of the stocks I don't even spend 1 minute. So maybe few seconds, 10, 20, 30 seconds I spend on each stock, and my job is discarding all the stock. So maybe after I'm done with this 520, 530 stocks, maybe I'll end up with, let's say, 30, 40, some good, I mean, reasonable ideas, 30, 40. Within that 30, 40 also, I will still discard it. So eventually I might end up with two or three good ideas, and then I'll try to value them. And if I like it, I like it, or generally I'm not compelled all this time, but from now on I should find one stock, right? So if I want to, I can find. So I think one stock out of 525 is what the ratio is for this month. I have seen 900 stocks also in this list, because right now we are in the overvalued zone. In the undervalued zone of the market, this number will be 700, 800, 900 stocks. So I may have to go through 6, 700 stocks per month. Out of that, I kind of pick one good idea. So this is how I pick, or I am going to pick stocks. Uh, and this is what I wanted to cover in this particular session. So how are you? Okay, I'm good. Okay, I'm 63-year-old. As per the model, I intend to invest 50,000 rupees per month in your recommended stock for next 3 years from Jan 2026. So I've allocated 18 lakh for the same. So 50,000 into 36. 8 is 18 lakh. So you want to keep it as a reserve, and every month you want to allocate. Okay. Further, you have indicated that you shall recommend some stocks whenever the market crash happens. Yes. So I also intend to keep some cash for lump sum investment as and when you recommend. Just like I have kept aside 18 lakh for SIP. What amount should I keep aside for lump sum investment in your opinion, as the market crash will not happen frequently? It may happen once during the forthcoming 3 years. So for lump sum investment, should be my ideal budget allocation? My budget for SIP is 18 lakh. I have asked the question to plan for fund flow statement according and keep them in liquid. What is the proportional ratio of allocation of funds for SIP and lump sum? Is it 50-50, 75 SIP, 25 lump sum? So here, basically, since you are 63 years old, so your allocation strategy, uh, I mean, the first objective that I have to consider only for you, but for me, it might be different. So since you are 63, so yours should be somewhere more conservative. So within the SIP and lump sum process, within that process, SIP is more safer, more stable, more consistent, since 100% of your capital is not at risk at every buying or selling interval. Whereas in lump sum, 100% of your capital is at risk if you are forced to sell at wrong timing. So we don't know like what emergencies you might have you might require going forward. So my suggestion to you specially would be your ideal allocation should be more towards SIP than lump sum. So 75-25, if you want to follow that, it's okay. It's up to you. But the only thing 50-50, I don't recommend. Lump sum should be slightly lower than SIP in your case. Since you are already 63, so that is one thing I want to cover. And is that the only question? Yeah. So yeah, okay. So the proportion should be dominant side should be the SIP side, conservative should be the lump sum side. So 75-25 if you want, you can go ahead with that. And for someone who is let's say 30, 35, 40 or 25, for you like the actual process is basically lump sum or SIP, there is no actual proportion. So what I would be doing is, let's say I have 1 lakh rupees income. Uh, let's say I have 5 lakh reserves. Let's say I have 5 lakh reserves. Uh, I might have used it for lump sum, that 5 lakhs. Now, whatever income that I am generating, let's say 1 lakh rupees per month, I am saving 30,000 from that 1 lakh. So my SIP would be 30,000 every month. That 5 lakhs or 3 lakhs or 2 lakhs, whatever reserves I have, I might have used that for the lump sum purpose. But eventually, my lump sum will be constant. Monthly is going for SIP only. So, for any given individual, based on the back tested data and all, what I have realized is SIP is more consistent, more stable. Return wise, also, SIP is basically, since we are not timing the market, we are staying in the market for a long period of time. So SIP is working better than lump sum. So for anyone, dominant side should be SIP. You want to keep it 50-50, I would say your SIP should be slightly more than 50%. Right now, if it is not 50%, it's okay. Right now, your lump sum might be slightly bigger. But going forward, when you allocate every month into SIP, so eventually your SIP will be bigger than your lump sum. Today, GHCL news of disposal of 16,000 shares by designated person. Okay. What does it mean, especially since fell by 6% today this quarter? I mean, someone would have. I didn't check because I was busy with the PPTs and all, so I didn't check. But someone might have sold 16,000 shares, designated person. So, one second. Public announcement. Okay, they are buying back the shares also. So, the company has published buyback also. So, 720. So, they are buying back at 720. 10 days back, they have mentioned it. So, nothing significant. So, no need. I mean, you don't need to worry because the investors, okay, 16,000 shares. into it's a 6,000 crore company. So 16,000 shares into 600, like what exactly? 1 second. 16,000 into 600 rupees. So 1, 2, 3, that is 96 lakhs. So it's a 5,000, 6,000 crore company, 5,800 crore company. So someone selling 1 crore rupees worth of shares, whether it is designated or whoever, so it's insignificant. So compare that 1 crore with 6,000 crores. And the company is planning to buy back also, which is again a good news, because right now the company is undervalued. So any buyback happening at undervalued price would create wealth for the existing shareholders. So at least for us, it's a good news for existing shareholders. And why the share price is, I mean, share price keeps on, fluctuating. Your follow-up question is, Surya Roshni gave a bumper earnings result, yet the shares fell by 9%. So is there a reason for this, since the shares hardly perform for a while? So the question of profit booking seems remote. See, why the share price is fluctuating, we cannot sit, we cannot sit and for every moment we cannot really give it some reason. We want to find, we can find some narrative for it, but most of the share price movement happens randomly. So most of it is random, and of course on the other side we have demand and supply, some global news or some news within the market, Indian market also fluctuates the overall index, which in turn fluctuates the individual share prices. So day to day moments, I don't know. If you ask me, like, it kind of gave bumper results, but why the share price didn't move up? Maybe the market expected even better than that. So beating the expectations or underperforming the expectations, there are so many things. So let's say company generated 10% growth, but everyone is expecting only 6% growth. In absolute basis, 10% is mediocre. Since everyone is expecting only 6%, the company generated 10%. So the company basically outperformed the expectations, so share price will go up. There is some other company which generated 15% growth, but everyone is expecting 18%. In absolute numbers, 15 is great. Since everyone is expecting 18, the company delivered 15, for them it is underperformance. So market, share prices performs in weird ways. Based on expectations, things work out here. So please don't take individual share prices or fluctuations in a very short period seriously. In my opinion, a SIP investing regularly for a certain period of time in a particular stock to take advantage of the price variations during the investment cycle. Whereas a lump sum investment is investing a lump sum amount for a certain period of time in a particular stock. But in your new model, though we will be investing every month systematically like SIP, we will not be investing in the same particular stock every month. Rather, we will be investing in different stocks every month. In that scenario, how we can take the advantage of price variations of stocks investment cycle. Uh, we are not trying to take one stock and every month, investing in that particular stock. Let's say I might have given someone's example a few weeks back. He is investing 1 lakh rupees every month. So he is taking that list of 15 or 20, whatever we had previously. He is taking that list, let's say 20 stock list. He distributes 5,000 rupees into all the stocks. 20 stock list, whatever, into 5,000 each. He is buying that way. So basically, he is following what you have mentioned here. Same stock, buying every month. So he is also averaging down that particular stock also. Since his capital is 1 lakh, he was able to do it. But what if I have already done the poll also? Most of the sensible investors here, their capital is 10,000, 15,000, less than 20,000 only. So with 15,000, 10,000, 20,000, they cannot invest in 20 stock list and kind of buy every month. So the model or the system that we implement should be, they should be able to execute. Everyone should be able to execute it. With your system, whatever you have mentioned, you need capital. If you are investing 1 lakh, 1,50,000, 2 lakhs per month, maybe you can do it. But someone investing 5,000 per month, they cannot do it. One. The second is, ignore all these things, ignore all these cycles. What we are trying to do here is, we are trying to place more emphasis on the exit period, not in the entry period. That is the reason I have done that, study also. What I have realized in that study is, so far in the last 10-12 years, I placed more emphasis on buying part. That is high growth, high quality, favorable price. I tried to place more emphasis here. What I have slightly ignored, not 100% ignored, slightly ignored is the effect of right selling. So the entire study focus on where the success for exit is higher. We realized more than 3 years would be a decent enough, exit. So through this process, it's not just buying I am focusing on. It is the selling part I am more focused on. So whenever you are trying to sell that stock, you should be able to sell it in the favorable period. So that automatically there will be some tailwind for you. Apart from your quality price, you should be supported with some kind of a tailwind. When that tailwind is happening above 3 years, it is more helpful. So selling is also considered. But hands down, whatever you have mentioned, if you can do it, it's wonderful. But technically, I cannot use it. 90-95% of our sensible investors also cannot use it, because they are investing 3,000, 4,000, 6,000. Someone is investing maybe 10,000. If you consider my case, the moment I speak about or recommend some stock, the next day onwards, I keep on answering those questions. So my 5-day, 30-day rule, because of that, I cannot use that process. So I cannot use it. More than 90% of our community cannot use it. So, but what you have mentioned is not wrong. If you can use it, then it is up to you, but we cannot use it. In the new model also, we'll be entering stock without knowing whether we have entered the stock in the right time or not. No. What makes you think that we have entered in the right time or not? We always enter at the right time. What is the right time for us? Valuation. If the stock is undervalued, if you are buying an undervalued stock, you have entered at the right time. But perfectly timing exactly, able to find the bottom, that we cannot do. And we are not even trying to time the exact bottom also. I mean, that is not even the objective. How do we ascertain that we have entered the stock at the right time when we buy a new stock every month? So we are using valuation and of course the margin of safety. So I mean, if I am able to buy a stock at 50 or 60 rupees, where its intrinsic value is, let's say, 90 or 100, so I'm getting some 25-30% margin of safety. So that is what I want, 25-30 margin of safety. If I can have in a stock while buying, I am happy to buy. But exactly like pinpoint precision, if I want to find something at pinpoint precision, I want to exactly do it, that I don't know, because no one can do it. With precision, no one can uh, give you that price. See, it is trading at 60, exactly it will go to 40 and it will revert back. No one can give you. Now you are looking at the positive side of it. Let me mention the negative side also. Let's say there are three stocks. One is trading at 100, one is trading at 90, one is trading at 80. From 100 something came to 20, from 90 something it went to 50, from 80 it went to 60. Now in that scenario also, you will be investing same amount, or will you be taking more advantage of investing in a stock which fell, where the fall is bigger? If you start doing that, you will be again start going for the best optimizing way. So whichever stock falls, you want to invest more in that stock. The moment you start doing that, again you will be over concentrating on a single stock in the name of averaging and all. So eventually people end up following a different process that what we have designed it. So I mean, you are on the right track, but very difficult to actually follow it. Can you please tell us about the RA course conducted by SEBI? Duration, fees, eligibility, exams. No, RA doesn't. There is no such special course they have done. We have to basically give NISM certification. You can find search on Google. You will find it. NISM examination for research analyst. Duration. It's a normal exam. Maybe fees I don't remember. Maybe 1500, 2000 something. Eligibility, there is no such thing as eligibility, but if you have a degree it's great, because without degree you cannot get RA a license. So for that you need degree. Fees is not high, maybe 1500, 2000. So NISM examination, one exam, semester or yearly, no, it's not like that. Only one exam you need to pass. But please, you can find that all this information on Google. So it's not as difficult as semester or yearly. No, it's a single exam, NISM exam. You have to pass it. Once you pass that examination, then you have to apply for SEBI. Now SEBI will go through your application, and then they'll give you the registration or the license. If all your documents and all, if they feel that you are eligible, then you will get it. I have gone through this month list. TV Today network is appearing. Regardless, I need elaboration and qualification. Company return on capital employed is not improving. Intrinsic value recommended 246. MBP was higher. From 2024 till the company's cash flows have not improved. Sales have gone down. Company has dependent only on Ask the channels for its revenue. Management is silent. We are not able to see the calls. Recent annual report, page 98 in Outlook. It has vastly discussed what it has achieved during 2024-25, but no major discussion on its goals to improve the shareholder value. 2nd May 2025, CRISIL has changed it. So what exactly is the question? So you mean to say that after looking at all these things, what is my uh, what I feel personally about the company? So I think uh, TV today might have crossed our 2 year whatever holding period, it might have crossed. So we have invested in TV today thinking that there will be mean reversion. So whatever the issues, I think we have done a separate session on TV today as well. So there I have mentioned like what exactly were the reasons. And if you can, I mean, I don't know whether you have asked. So we have stopped encouraging people for averaging down in TV today long back. So maybe few months we are not encouraging people to average down on TV today network, because we also feel the expected improvement, whatever the improvement that we have expected from TV today, is not happening. But we didn't give a sell call also. So we expected few things, but I mean, we are still confident, but not as confident as we were. So that is what I would say. But let the January come. So there are few stocks which have crossed 2 years of holding period and still didn't perform. So from Jan onwards, we will be kind of taking those stocks off the list. Not immediately, like I'll give 10 sell calls in 1 month. No, I'm not going to do that. Maybe each month, one, two stocks we will be selling from here on from the older list. So TV today, if in next 3 4 months if it doesn't perform, maybe TV today also we have to take that tough call. So yeah, there are so many. I mean, there are so many other red flags also with TV today, and we have given. I think personally we have given enough time for the stock to prove its potential, but it's not happening so far. So the next question is from in the new monthly stocks, do I have to put say 1 lakh in one go, or do it in SIP over 5 6 months till the CMP is greater than MBP or less than MBP? Is it only one time investment or not to invest in it in next 36 months? Rama Ananda is it's a one-time investment. So each month we will be recommending new stock. So it's not like, and whatever the research report that we share, or let's say whatever the stock we recommend, there is a timeline, like it's a 30-day window period. Within that 30 days, you have to invest. Let's say in Jan, I have recommended, let's say GHCL. I recommended GHCL in Jan. It is only valid for Jan investment. You shouldn't invest in GHCL next month. In February, we will be recommending a new stock again. So you have to go for that new stock. So it's only 1 month. Don't do like SIP as long as the stock is below MBP. Please don't do that. It's a one-time investment. In spite of all this drawback, it is on top of our recommendation list. My point for discussion is okay, you have a follow-up question. Double our capital once in 2 or 3 years, which was your mentoring class during the year. Around 43 stocks have given 100% appreciation during 1 year in our portfolio. Only Coromandel tried to touch that. Take the case of Apollo Microsystem through the company has failed in showing cash flows to us. Its management dynamism helped it to give 3x in just 1 year. Though the company is failing to travel in that direction within active management team, we can achieve that in this stock. We are value investor who invest thinking that while buying only, we ensure margin of safety. In this case, the margin of safety crossed downward long back and we are going towards SIP. In this case, that is averaging. Does the company trying to improve its economic mode so that in due course it can improve the shareholders' wealth? I'll agree with all the things, but the last thing that you have mentioned, like we are going towards SIP that is averaging, no. Long back, I mean, people whoever were communicating with us, you have to understand one thing. TV today is at the top of the list, but we are basically I mean 15 stock, whatever the list, we are creating that list for monthly investors. I have multiple times mentioned it. Lump sum investors invested in a lump sum portfolio and they have to sit right. So they have nothing to do on a monthly basis. Only monthly investors are using our list every month. And I mean, it's been quite some months now. I didn't acquire any new client. So basically, we have stopped acquiring new clients. The new clients will only come in January. So, in fact, no new individual is buying TV today. And for people who are buying within the community also, we said, don't average down TV today. So, even though it is sitting at the top of the list, I am not really worried in that case because no one is investing in that stock. Because we are not even taking any new people. I mean, whoever are there with us, only they are with us. So, we have stopped onboarding long back. So, on that front, I have no issue. So going forward, if it performs, it's okay. So never say never. But the chances or the possibilities have slightly gone down, and moreover, it's the opportunity cost, like how long we need to provide the time also. So that timeline also we have crossed. Uh, so in any which way, I don't encourage averaging down in TV today, but it is still in the holding zone only. We might give it some more time. If it doesn't perform even after that, then we have to take our call. Do you get annoyed? Do you get annoyed when amateur investors start doubting your analysis when in fact the market conditions are unfavorable? No, I don't get annoyed because I've seen the history. Like in 2001, during the dot-com bubble, uh, I mean, Warren Buffett in 2000 also has got some 50 plus years of investing experience. Warren Buffett is world renowned investor by then. He's a billionaire. He made like billions of dollars through investment. And during the Berkshire Hathaway meetings, he would be grilled, literally grilled. Like every year they conduct the annual meets, right? So for that during that dot com bubble, For 3 4 years, people used to grill him during those sessions. Newspapers, media, like everyone, of course, back then social media was not as active, but newspapers or news channels and all used to publish big articles saying that it's end of Warren Buffett. Then when people doubt someone like Warren Buffett with 50 or 60 years of experience making like billions of dollars, if someone is doubting me on my analysis, like I am already humbled by knowing the history. People have called Warren Buffett the names. People will call me also the names. I am okay with it. When Buffett is not spared, who am I? So it's okay. I don't get annoyed. It's fine. It's part of the process. And Buffett also said in bull market, they'll treat you like God. Because in bull market, everything is favorable. You will generate multi-bagger returns and also they'll treat you as God. But during the bear market, when market conditions are unfavorable, when stock doesn't perform, they'll treat you as dog. So when I'm okay, when people treat me as God, I should be okay when they treat me as God, a dog. I'm okay with both the instances. Now it is bear market. I have to be little humble. When bull market comes, then table will turn. Then again the stock starts performing. New people will come flock into the market in thousands. Again, it's a cycle. It keeps on the cycle keeps on rotating. So it's okay. I don't get annoyed. Vindhya Tele was up by 15% yesterday and Explore Solutions by 10% today. Any reason? No, I don't know. But if it is going up 15%, if something is going up 10%, it's good, right? So we should feel happy and leave it there. Exact reason. See, every day the share prices move. So exactly we don't know like what's happening every day and it's waste of our time. Uh, for exactly to stop this, we are starting the VD 3.0 automated. So what we'll do is like we invest and mine will start in 15 days because I am going to buy in December only. I will recommend it on, I need that 30-day gap, right? So I'll be buying in 15 days. So right now I am already going through that, shortlisting process, like what I am buying and all. So that's happening right now. So I'm busy in that. Something going up 15%, something going up 10% today. I'm not even bothered because I'm worried with something else. I'm occupied here. So mine will start in 15 days. New, VD 3.0 automated. Yours will start in Jan. No matter where it starts, we know where it is going to end. Whether you buy Vidya, whether you buy Explio or new stock, whatever, you will hold it for 3 years, whether it is going up 15% or falling 20%. Upside or downside, I don't care. So at least from January, if someone is asking this question, whatever it might be, you hold it for 3 years would be my answer. And honestly speaking, whatever is happening, the price movements, mostly it will be random. So don't try to kind of dig deeper in terms of price. Uh, Please let us know about importance to invest in national highways. What do you mean by national highways? Like government spending on national highway infra, you mean that or national highway stocks? Uh, I didn't get the question because it's a sentence that you have mentioned. Government spending on national highways through private owners or private companies or PPP, that is private public partnership, I would encourage them. Yes, they have to invest in highways from 4 lane, it should go to 6 lane, it should go to 8 lane, it should go to 20 lane. Like infrastructure, lighting, sanitary, everything should be improved, top notch. But I don't invest in those companies. I don't want to invest in those stocks because I want to enjoy the infra, but I don't want to be a shareholder in those companies. Reason is pretty simple because it is highly regulated. It is mostly social costs. They'll put a, you have to spend crores of rupees. How do you collect it? Put a toll over there. Toll plaza, you collect fees for let's say 5 years, 10 years, 20 years, whatever might be the agreement. then suddenly government can do whatever they want. If there is a public outrage for, let's say, increasing the toll prices, the government, it's a social, I mean, ours is not a capitalistic country, ours is a socialistic country. So suddenly government might say don't increase the tolls. And the good news, they might not even increase the timeline also. From 20 years now you go up to 40 years. Collect, no, they'll just stop you, they'll cap you from, charging extra money. How will you recover your capital back? So in a socialistic country, it's good to enjoy the fruits, because anyway we are paying taxes. It's not free to us also, but in such where social element is bigger than the capital or economic element, my objective is very simple. I don't touch those companies. I want to be outside that space. So yes, they have to invest in national highways, but if there is any company that is doing that job, I will not invest in that company. I have no interest in doing charity by investing in that stock. I am paying taxes, right? So my taxes itself is a charity in a way. So it's double charity if I invest in those companies. Mithon alloys operating profit margins impact. No. How do you see this koi doing in 2 years? Since uh, Mithon alloys is not mean reversion kind of. We have invested it as a asset play. So I mean, look at the liquid assets or uh, the investments of the company that is bigger than the market cap. So we have invested it as an asset play. Now, what's happening in 2 years? In the last 2 years, what happened with this company is, I'll be honest with you. I mean, for the last 2 years, nothing happened in the market also. For the last 15, 16 or 1.5 year, market is muted. So we shouldn't blame Mithon Alloy for that. The entire market is muted. So that is the reason most of the stocks didn't generate the kind of returns generally we would expect. But it is natural. It's a natural cycle. For the last 1.5 year, market is basically muted. Market didn't generate any return. So it would be, asking for too much if I am pointing out at one stock and saying this stock didn't do anything in 1.5 year. The entire market has done nothing. Entire Indian market has done nothing. So I don't want to blame Mithon for it. But it's not an asset play. Of course, net margins or operating margins, whatever you have mentioned, I can understand, but we have not invested in the stock for that. We have invested it as an asset play. It didn't work out because the entire market didn't support us. But this is not going to continue forever. So eventually there should be a rally. And honestly, right now the market is overvalued. Market is still overvalued. The good news is it is in time correction. Market is in time correction, or else the market should have crashed since, I mean, it should have crashed way before. It is not crashing, but it is in time correction. So Mithon or every other stock is going through that time correction phase. Vineet, I mean, this is the question. So this is what I mean. TV today, I think there are few questions on TV today connected to the 2 year. It has already gone 2 years plus. So again, Vineet, we have recommended a particular stock thinking that it would perform, but there is always a probability that some things doesn't go the way that we expect. In next 20, 30, 40 years, there will be many such stocks which might not go the exact way that I wanted, which is fine. But going forward, the issue that you are mentioning, that this stock is in the list for so long, like 1 year, 1.5 year, I also have that problem. I also don't want a particular stock to be in the list for so long. But do I have any chance? The stock is below MBP. If I remove it from the list, everyone will panic. Why it is removed? Because it is below MBP. So I don't have a choice. For next 1 month, I don't have a choice. But from Jan, I don't have at least this, headache. No, I also have this particular headache. And I am being honest with you. So that is the reason I am changing the entire process. Like when I am recommending the stock, I should be 100% certain that this is the right time to buy this particular stock. I am giving you 30 days window period because 30 days is relatively a small period. Within that 30 days, there won't be enormous change, right? So drastic change won't happen. So that period would be the best period to buy. After that, I am not recommending it to anyone. If there is any fundamental deterioration after 3 months, after 7 months, after 12 months, if there is any fundamental deterioration, I can give an outright call saying exit, which I don't have with the current system. That is the reason I am changing it. So I may not have covered all the things because there are so many issues with the current system, but this is one of those systems. So, and of course, I am not being very vocal about it, but you need to understand, if in this VD 3.0 automated, I want 99% of the things to be automated, but it doesn't mean that we are going to blindly hold anything going forward. If we think, I mean, the stock's fundamentals are deteriorating, we might give a sell call in between. Or after 3 years, we think the stock can still perform. Maybe we'll ask you to hold it a bit further, more than 3 years. Let's say we can go to 4 years. So these are exceptions anyway. Rule is 3 year. 90-95% of the time we buy, we hold for 3 years, we sell. There will be exceptions. In the current process, I am not able to use those exceptions the way that I wanted. So I want to get out of that. And I want to work with a lot of freedom, which the current system is not giving me. So that is the reason I have, for 1 more month, I think I need to answer all these things. After 1 month, I'll get more freedom. So I can do things the way that I wanted, which can be more beneficial. So that is the reason I am also, transforming to a new system. So we are value investors who think buying, okay, I think I've already done that. Are we trying to invest expecting mean reversion? As you are aware, in US, mean reversion investors are waiting for last 3 years to catch the stocks, but uptrend stocks are not available in the same time. Available stocks are not taking uptrend. See again, 3 year period is a very short period, if I have to put it that way. So uh, 3 years is like a blink of an eye. For someone, 3 years might be a very long period. But I mean, take value investing as an example. In last 70, 80 years, value investing might have not performed for like extended 10, 12 years. Maybe growth investing worked during that period, or maybe momentum investing worked during that period. But you know who made biggest money? Someone, let's say you are using a process, be it mean reversion, be it cyclical investing, be it cigar butt investing, let's say deep value stocks, or mode investing. You go for momentum investing. Whatever process you want to follow, you follow. The only thing that you need to do is follow it for a long time, 10, 20, 30 years. Everyone makes money. Value investors makes money, growth investors makes money, momentum makes money, cyclical investors make money. The only difference is, the only person who doesn't make money is, for 2 years you are a value investor, you saw value investing is not working, you went to growth investing. Suddenly the moment you go there, growth investing stopped, value started performing. Then you went to momentum investing, momentum stopped, mean reversion is performing. So if you are roaming the place for next 10, 20 years, your returns will be mediocre. So find one process, use it for a long period, you will be successful. In between, there might be some unsuccessful periods, but you have to be patient enough to kind of stick to that process when it is not working. So everything is cyclical. Value investing, growth investing, momentum, everything is cyclical. If value investing is working, then momentum will stop working. If growth investing is working, maybe at that point, value investing might stop working. So, but over a long period, every investor will get his due time to generate the better returns, that 2 3 years of lost period will be covered in next 2 3 years, which is fine. But just because last 3 years it is not working doesn't mean that we go and find a new discipline every 2 3 years. Then our portfolio will be all over the place. Finally, India's indexes are showing that overvalued, but major reduction is not found in its broader market capitalization. Only our portfolios are not moving up. Now, I urge to clarify with all these negative factors why this stock is occupying our. Is there any hidden growth driver for this company? So you asked me all these questions only for TV today. No, there is no such hidden growth driver. Like whatever I feel, I've already kind of mentioned in that. Uh, whatever the session that I have done for that stock. So TV today, we thought the drop in the margins or whatever, like they can, there what we have under you know considered, we didn't consider is the investment in next generation assets. So they have to invest in the social side. I mean, they not hard assets. Their conventional media is not going to help them. So they have to build their social media platforms. The investment related to content and all is much expensive than what we have thought. The content has become much expensive. And the investment in this side of the business, I mean, even the company didn't might have not felt that expanding toward this area need that much of capital. So they are spending a lot of money, but the return on that capital is not lucrative. There might be many reasons to it, uh, but whatever reason, I mean, the value migration happened towards the social media side. They also investing a lot of money, but for every 1 rupee that they are spending, they are not getting enough value in return. So on one side they are doing capex, on the other side they are not generating any return out of it. And if you look at their conventional media business, that is also not growing. So I don't see any hidden growth driver. I only see a declining company over there. So from here, it will be a turnaround situation for us. So back then it was a mean reversion situation but from mean reversion, slowly it moved towards that turnaround situation, which I think is difficult. But I am not losing hope at this point. But I am not going to hold it forever also. So I think the company already moved out of our comfortable holding timeline. We'll see in Jan. Now, this is one more biggest issue that I am facing right now with the current process. That is, see, over the last couple of years, we have recommended many stocks. There were some 5 baggers, there were some 10 baggers. Some companies generated like and all of them have moved out. And for the last 1.5 year, like the companies that didn't move are stuck here. And these companies are not moving because whatever the market is not performing and all. So I mean, last 1.5 year, I also feel like we have recommended so many stocks. I mean, none of them performed or what? Because it's been continuing for 1 year, right? But when I do the introspection, when I go through our past recommendations, so I have realized, okay, we have identified enough multi-baggers, but the only issue is last 1.5 year, the market is not moving, and the list and the stocks in the list also you can see the stocks that didn't perform ended up in the list. And I don't want this to continue forever. So one more reason to kind of change the process. So I want to be more flexible. So going forward, I don't think I will be answering this because I can sell or I can move out of a stock much faster because I am not recommending that to someone who bought it, let's say 3 months or 2 months or 1 month back. If I'm giving it, it might have been a long time or mostly same timeline. Newer ones will not be buying those previous stocks anyway. Vishnu, I am with you since 2022. RVNL, IRFC were multi-baggers, but by monthly recommendations, we will miss also for newcomers. This stock will go out of their radar. I feel monthly list is important as we have the freedom to invest in both. Kindly consider giving the monthly list. I have invested 5,000 shares in RVNL and sold 300. My investment value was 40. Okay, you invested at 40, you sold at 300, 5,000 shares, well and good. But why we are not continuing the monthly list? I have done a 4 hour session. So, no, monthly list is gone. Monthly list from Jan, we will be going towards the one stock per month. And what exactly you are expecting? For newcomers, this stock will go out of the radar. No, I am not exactly thinking of a newcomer because for newcomer, I'll be giving a new stock for them. So my funda is very simple from here on. Everyone's return should be more or less aligned with each other. Of course, if someone is joining next month, at least everyone who joined next month, their returns are everyone's return from that month will at least be same. So your history will be history, but from Jan, all portfolios, for example, if I'm answering a question on, let's say, a particular stock, it should be very clear like everyone made money or everyone lost money. It shouldn't be like someone is asking me KRBL question. I don't know whether that person made money or not because we made money in KRBL. Some people it is at break even. Some people might have lost 10-15%. So we exactly don't know. If someone asks me about KRBL, I am clueless. Did you make money or you are at break even? Where? So going forward, I don't want that to happen. And your RVNLs, IRFCs, anyway, you are not going to miss. So you don't worry, you will anyway get those ideas. And I am going to mention the MBP also. So in the report, MBP is also mentioned. And I am here. So, but I won't let you to buy after that 30 days period because again if I have to answer again newcomer will come and say like you didn't recommend RVNL IRFC. No, these are older investments, so there will be a lot of headache. So at this point I want to reduce my headaches. I want to focus more on the research part. So I want to dedicate more time on research. Monthly list is not a simple like 5 minute job. Monthly list also takes 3-4 days for me. So that 3-4 days it's better for me to dedicate for research. What do you think of? Okay, I have not recommended that stock, so I won't comment on that stock. 12 months, last 12 months only high quality stocks were appearing enough. Suddenly you can identify one stock like Nadaraj. I think you didn't watch my that 4 hour 3 hour video, I guess. So Nada, is it okay, Nadaraja. uh, I mean, I think you didn't watch that. Please, you can get that video from the team. They'll send you that it's 3 hours or 3.5 something. You have to please watch it because there is a reason for I was not able to find those stocks. So I think I've mentioned all the reasons and all. So you please go through that video. It would be much better. November 2024, you have started, which is 1 year. Ram, 1 year, I mean, what should I comment? Like in 1 year, Nifty's return is bigger than your portfolio return. Like, what should I comment? So 1 year is not the right period, which is absolutely, I would say not even enough. 1 year period, if you are calculating XIRR and comparing it with Sensex or Nifty, then no, it is very too, I mean, not even short, like it is extra short term period. So at least 3 years or 5 years is what it would be better for you to, compare. Not 3 years. And one more thing, you have started it with at certain level, so it's not consistent also. You didn't sell any of them. And most of the stocks would be like recently you might have added. And the process that we use also, mostly we are contrarian investors. So when we are buying a stock, 90% of the time when I buy something, the probability of going down is higher than going up. Because by default, we are buying undervalued stocks, unpopular stocks, contrarian, because they are falling. That is the reason they entered this undervalued zone. But Sensex or Nifty is a different, group of stocks. Some of them might be value, some of them might be growth stocks, some of them might be in momentum. But our entire 12 stocks or whatever stocks you have bought, they are all value stocks and in the downtrend. That is the reason, and in unpopular zone. Now you have to give that portfolio time to prove its potential in next 3 years. Maybe then it would outperform that particular index. So 1 year is absolutely very little time. So going forward, so you please look at long term. There are so many reasons why that portfolio didn't beat the Nifty, but I don't even want to answer it because my only answer is 1 year is not enough to check returns. Guys, it's already 10:30. Raju Royal, uh, please don't average down. No, because we are going to uh, start new process, right? So whatever you have cash, instead of averaging, you can invest in our new process, right? So no, averaging Raju Royal, please don't average down. So okay, chalo, we are anyway at 10:30, right? So I'll see you again. Of course, this video will be shared with you. So chalo guys, good night. I'll see you again next Friday 9 p.m. Till then, take care.